It's an interesting space you're going into, banking, particularly regional banking. When I think about that, it's a very unloved or at least untargeted sector for activists. Why are you going into it?
Well, the big reason is that there's a lot of low-hanging fruit there. I mean, the banking sector in the U.S. remains incredibly fragmented. There are about 5,000 banks left in the U.S. It's an industry that's been in consolidation since the early 90s. It continues to consolidate. There's a tremendous amount of M&A in the space. About 5% of banks sell every year. And the banks that we're targeting need a little bit of a push to take part in that consolidation. It's also
and how do you do that? What does that involve, that push? How do you catalyze the M&A?
Well, I think it's two things. I mean, I think the best way is just to point out the advantages of selling to shareholders. So I used to be an investment banker. We'd make these presentations and say, look, this is what you're going to look like on a standalone basis, and the prospects are, not particularly exciting. You can actually get a great return for shareholders right now with much greater certainty by selling rather than embarking on some type of turnaround plan that could take years and have a very uncertain outcome. So one of the ways is showing the board and the management teams what the opportunity is. The other thing is, quite frankly, making the status quo a little uncomfortable for them.
And I'm interested in that because, look, without being unkind to small regional banks, I can't think of a sort of obviously less jazzy area of the corporate world. How do you create that sort of narrative excitement and momentum that you need as an activist to get shareholders excited, to get people on board with a change of direction for these companies? Well,
the shareholders is the easy part. Most people who invest in small banks are investing to some degree based on a consolidation play. So within a small bank, any kind of publicly traded small bank, there's a large percentage of the shareholders who are there waiting for a sale anyhow. In terms of creating the excitement with the board and lighting a fire under them, a lot of these banks, they're not very well covered by research. Some of them are, we'd say public, orphans. They're sort of public in name only, but they act like they're private. They do things that, once you expose it to a larger audience, it makes life a little bit less comfortable for the directors. The other thing is these banks, in many cases, have been able to exist for long periods of time with really, unexciting performance. And when you highlight that and then you contrast it with what they might get in a sale, I think it's a real wake-up call for the directors.
And the logic for consolidation is what? Because it does seem like if you look at the banking sector generally, but particularly mid to small banks, it really just seems to be delaying the inevitable disruption that tech is going to deliver on this industry.
Well, I think it's that. I think the bigger thing is that the U.S. banking industry is far more fragmented than any other industrialized country, and it really stems, I think, at the core from two things. Americans historically have just had a huge distrust of large financial institutions, and then community bankers, small bankers, have always had a great lobby, whether with the states earlier on or with the federal government now. So there's no reason for it to be so fragmented, because banks have a tremendous ability to take advantages of economies of scale. That's why you see, in Canada, for instance, there are 85 banks compared to 5,000 in the U.S. Their top 5 banks control about 80% of the market share. In the U.S., the top 5 banks control about a third of the market share. So there's just, you're kind of eliminating this artificial, barriers to consolidation.
And how do you factor in the recessionary risk? Because look, we have this sort of, rogues gallery of harbingers at the moment, whether it's yield curve inversion or the S&P going down as much as it's gone down in the last few days. Banks are very susceptible to that, the smaller and mid-sized banks even more so. So how do you invest in these, even if you have a good plan, when it's potentially they're going to get wiped out going into a recession?
Well, I don't think they're going to get wiped out, first of all. I think that, the recession, if we're looking at a recession right now, it's not the type of recession we saw, during the financial crisis, where it was really a credit bubble bursting. This feels more one where growth is just going to slow or contract. And there are a lot of banks out there. Banks the banks that are going to be the consolidators need to keep on showing earnings growth to their shareholders, to the market. The best way for them to do that, if loan growth or other avenues are slowing down, is through M&A. They can come in, they can take out a tremendous amount of cost saves in a deal, and that's a great way for them to show earnings growth. And then also, you're able to get greater scale in markets. They're able to expand it into new markets. So it's a wonderful way, once organic growth starts to slow down, for them to continue to show shareholders some earnings growth.